We believe that as long as you are willing to be a long-term investor through systematic investment plans, or you're a long-term investor, value is a very interesting way. And we do not like to look at just 1 year returns as a framework, because 1 year tends to be more volatile than very long periods of time.
Mr. Naren, your value discovery fund in particular has delivered an impressive return of 25% in the last 1 year despite all the volatility around. So, what clicked? Do you think value stocks are going to be the best bet as the Fed starts tightening?
Value is a very interesting investing framework over the long term. And we are not believers that one should look at a 1 year framework for evaluating value. So over the last 18 years that the fund has been in operation, there have been periods of time like 1 year, like 2007, 2017, when the fund did not do well. But if you look at over a longer period of time, value is a very interesting category, because we try to look for areas where the markets are ignoring and where there is a good intrinsic value.
India Opportunities Fund, which is also managed by you, has delivered spectacular performance since its launch 3 years ago. So how do you go about spotting themes for this particular fund?
So we look for special situations, which effectively means we look for problems. So for us, we are always looking for problems. So for example, when COVID struck, we found that metals was something which was really interesting, because people were very negative on metals at that point of time. And people said that automotive stocks will do well, consumer durable stocks will do well, but they don't require metals. And people were actually not willing to buy metal stocks. We found metal as a very good special situation at that point of time. So we keep looking for areas, special situations all the time. And then when we find a special situation, we actually invest into that special situation. And the global experience in special situation investing has been that if investors are longer term, actually it turns out to be an interesting area. Global experience of special investing is situation investing has been good, because you always tend to buy something which is in trouble. So you are actually buying at a low. And when the trouble goes away, actually you tend to make money. The problem is you don't know how long it takes for the problem to go away. So for example, today you have a Ukraine war. Due to the Ukraine war, there'll be certain things which you can look at as a special situation. And due to that, you will get some opportunities. And once the war goes away and some of the effect of the war goes away, you will see some benefits. And that gives you an opportunity. So like that, we will always be on the threshold of looking for special situations. And, it requires a certain behavioral framework, because you can't be worried about negative events. And that through the 18 years that we have looked at in ICICI Prudential, we have found that we are not scared of negative events, whether it is the global financial crisis or the European financial crisis or COVID. We are not scared of negative events, because we have found that those are all opportunities for long-term investors. And that is the framework that we've used.
Which all pockets of the market do you spot an opportunity right now?
Broadly, if you look at it, large caps itself is a opportunity relative to what it was. Because if you look at the bulk of the selling has been in large caps, bulk of the selling has been in banks. So if you're asking me, large caps and banks are two areas where we've seen a fair amount of selling by the foreign institutional investors, because banks and financial services was the number one area of holdings of the financial institutional investors. So that is, I would say, the number one area where they've been selling. Small and mid caps has been the area where we have seen least amount of selling, because bulk of the holdings there have been in the local domain rather than in the foreign institutional domain.
What about bank stocks? So are FIs the only reason why bank stocks have failed to outperform? And how bullish are you on this particular?
That, in the long run, banks with very good current account and savings account franchises should do well, given that in the last 3 to 5 years, interest rates have been low. and credit growth has been low. With oil going up, the demand for credit should go up, and that should actually help the cause of the good current account and savings bank franchises. So we believe that credit growth inadvertently will be helped by the high oil environment, because high oil leads to higher credit growth. And that is why we are a big believer in good credit savings account and current account franchises at this point of time. And therefore, we think that the outlook for banking is superior. Having said that, as long as there are redemptions in the foreign institutional community and the local institutional community, we think the sector cannot do well, because it is a big part of every institutional portfolio.
What about new age stocks? So most of the new age stocks have disappointed investors who were initially very, very excited around the IPOs. So when we look back now, what are the key learnings that these listings have taught new retail investors?
We were always, we are taught to look at cash flows. We are taught to look at operating cash flows. We are taught to look at profits. And our learnings from 1999-2000 was that anything which is based on eyeballs carries more risk. And that was in the internet boom of 99-2000. And therefore, we were always much more careful in this area. And historically, we've seen any business model which is built on not on earnings, but on all kinds of top-line based models, you have to be much more careful. And I think that is the learning that is there. And I believe that, so far, despite the fact that we did participate in a few new fund offers, IPOs, we actually booked profits in some of them, and we had a good experience thanks to the efforts of some of the younger people in the team who told us to participate in them and book profits. So I would say that you have to be always, you have to have an open mind and you have to be skeptical. So I think the combination of having an open mind and being skeptical is a complex situation to be in, and that is the framework that we have used, along with a steady thinking on risk. And I believe the fact that investors have lost money in some of these new age ideas means that the future IPOs will come at a much more reasonable pricing, and that will make the job of investing for all of us much easier.
Can you elaborate a bit on the process that you follow for valuing these new age companies, some of which, or rather most of them, have never made any profit?
The lessons that we learned is all coming out of US. See, finally, at the end of the day, if you look at it, it is the FAANG stocks which have delivered huge shareholder value. And each of them created big moats finally. So you have to evaluate whether any of them are going to be able to create moats over a period of time, whether there is going to be an entry barrier once they become bigger. If they're not going to create any moat for a new person, and there are going to be endless number of new players which are going to come in this industry, then it's going to be very difficult for the new player. And we're also looking at whether the incumbents are going to work to actually compete effectively against the new entrants. End of the day, you have to have a moat. If you look at the experience of FAANG companies, many of them have created very strong moats that today even in India, we are dependent on some of our FAANG companies on our day-to-day existence. Having said that, India is in the infancy in this area. So it's possible that one or two of these companies may create the moat over the next 5 to 10 years. So sometimes it may make sense for you to take a very small position in one of these stocks in the hope that these people will create the moats, just like what the FAANG companies created in America. These companies may create moats in India.
Investing in these kind of stocks is more like spray and pray.
We are managing public money, there is no concept of spray and pray, because if we are managing public money and we start spraying and praying, then we'll have to spray and pray in front of public investors. That's not the goal we have set out. Finally, at the end of the day, we have been given hard-earned public money to manage, and we have to manage that public money in the right way. So we don't have this concept of spray and pray. We don't have that concept at all ingrained. And that is the reason, we have, for example, we created this entire category called balanced advantage, which many of the other mutual funds have also launched. Today, for example, we have products like ICICI Prudential passive multi-asset fund of fund kind of products also. Each of them have their own riskometers and their own kind of frameworks. I don't think it is at all right for a mutual fund to believe in a spray and pray model. We are managing the hard-earned public money of all the investors, and we have to manage it in the right way. There are, as it is, market risks, so we don't believe in a spray and pray model.